Hello, everyone. Good afternoon, and thank you very much for joining me. This is our webinar titled Risk On, Risk Off. And I'll just introduce myself. Of course, my name is Russell Shaw. I'm the Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. And today is Friday, the 18th of October, 2019. I'll just bring up our disclaimers as I usually do. I'll leave them on screen for a few moments. And this webinar, I actually decided to put something together. I got an email from Matthijs. So thank you very much, Matthijs, for suggesting it. Hopefully I do it justice. I think that it's a very, very interesting topic. And I'm not sure exactly how the interactions are going to go, sort of in the next hour, perhaps hour and a half. Maybe there will be a follow-up webinar, but I think that it's a very, very interesting part of the markets. I just keep this hypothetical simulated performance disclaimer up as well. And I think to start off with, the whole idea behind risk on and risk off, it is actually it's almost one could think of it as a model, okay, in terms of how you want to allocate your assets. And I'm hoping by the end of this particular webinar, there is a clear, I guess, explanation of the model. So I guess it's important to realize we operate. Okay, we're all traders. Okay, and we all operate in a world of risk. Okay. And it's very important that is the case, because if there's no risk, well, guess what? There's no chance of reward. So the fact that there is risk, we do need to accept that and embrace that, because without the variable called risk, we wouldn't be able to speculate and participate in the financial markets. And what I think is tremendous when it comes to speculation, it's really it's a true. I think it's a true test, because I think we're at the stage now when we all recognize that it's actually more a mental exercise than anything else. It's truly to be successful in speculation. We have to understand that it's a very big exertion and pressure on our psychology. And this whole week, if anyone has been trading the cable pairing or any of the pound crosses, I think that by this stage of the game, or by this stage of the week, I think whoever you are, you would probably be mentally exhausted, kind of welcoming the onset of the weekend. But guess what? This weekend just happens to be the biggest piece in the whole puzzle. So the mental aspect and the exertion is very is still there. So the interesting part of this weekend, and we spoke about it in our webinar earlier, is, well, how certain are we that this deal is going to get passed? And in the same sort of breath, we can ask the question, how certain are we that this deal is not going to get passed? Okay, so the fact is, this uncertainty, okay, this uncertainty makes this weekend a tremendously risky weekend for notably cable traders. But I think, as Richard suggested earlier, there are other pairs. The euro he brought up is most likely going to react off of this as well. Very likely that the FTSE will react off of this, and there's all shapes. I beg your pardon. There's all types of market participants, and they're all participating in different markets. But this vote that's taking place tomorrow is so uncertain, that it is so risky, that there has to be some sort of reward associated with that. And that is exactly what risk is. And within that broad definition, we're looking specifically at when is risk on and when is risk off. And we'll get into the definitions of those in a moment. Okay. The whole idea is, if we can manage our risk successfully, then the reward is the result. And that's essentially what risk off, risk on is. It's a mechanism for trying to manage your risk, because the idea here is you and me and market participants in general have to choose how we're going to allocate our capital based on whether there is a heightened sense of risk in the market or a lower sense of risk in the market. Okay. And it's very important for us to try and make an assessment of that type of sentiment. Right. Any questions there before we continue? Just it goes without saying that any questions that crop up, just type them out. Don't hesitate. Just type them out as soon as I see them, and given the opportunity, I'll relay that to the attendees. Now, given this big deal about risk, okay, it really comes down, and this is the key word: tolerance. Tolerance. Okay, how much risk is a market participant, be it a trader, be it an investor? How much risk is that particular participant willing to tolerate? Now, there may be instances in the market, okay, when the market participant is willing to tolerate more risk, okay. There may be other instances in the market when the participant will prefer to tolerate less risk. So how do we assess that? And to be honest, it's tricky, and we're going to try and cover it as best as possible here. And let me just bring up a chart. Okay, so this is going to be a trading view chart, and I think that we can bring up a Bitcoin just for the time being. Let's bring up Bitcoin. Okay. Hang on, I haven't put it in properly. Let's put in Bitcoin USD. And the question is, remember, how do we know when we want to tolerate more risk, and how do we know when we want to tolerate less risk? So let's just take a look at Bitcoin. All right, so I'm taking you all back to the end of 2017. Okay, let's perhaps try and block it out like this. Let's bring up the drawing tool. Okay, here we go. So let's just say we're here. This is November. Oh no, let's go back. Let's go right here. Okay, so my question to you, now this is the week of the 20th of November 2017. Take a look at the run up in Bitcoin. Okay, it's been really a superb run up at this stage. Okay, you can see this is the run up. Let's just bring a little cover back. And my question I pose to you guys is, at this stage, do you want to tolerate risk by investing in Bitcoin or not? At this particular stage, okay, who would be happy to go into the market at this stage, or who was happy to go into the market at that stage and invest into Bitcoin? So Nico at this stage is suggesting that Bitcoin is high. So I'm going to ask a question, Nico. Okay, and again, this is a complete webinar, so we should have an answer to this by the end of the webinar. How do you know it's high? How do you know it's high at this stage? How do you know that it's not relatively low? So without, I mean, in hindsight, it's easy to see. Okay, it's easy to see in hindsight, but at this stage, how do we know if it's high or if it's low? So Frances suggests that she was a market participant at this stage. Matthijs says that too little information to analyze the market, and Nico says, well, it's been trending for a long time. It's probably coming towards the end of the trend, and if we move this forward, we can see for the next month, it actually goes what we call parabolic. It shoots almost vertically. And then after that, it starts coming down. Okay, so we may refer back to this. I think that the Bitcoin cycle is a very, very interesting study, particularly in this topic that we're discussing this afternoon. Let me bring back my little risk on versus risk off. So keep that Bitcoin chart in mind. We'll likely refer to it again a little later. And Skulk suggests that it looked good to buy at that particular stage. So what I want to suggest is perhaps there are telltale signs when perhaps the risk is getting a little skewed, and that maybe tolerating that amount of risk is not the right thing to do. So let's carry on with our discussion. When market risk is perceived as low, market participants are generally going to be willing to buy or go long or invest or trade in what we call higher risk assets. Okay, when market risk is perceived as low, in other words, when I'm talking about risk, I'm talking perhaps about the uncertainty surrounding that. So when there is a perceived view that that general market uncertainty is not that high, well, then market participants may be, and most probably will be, willing to expose their money to higher risk assets. And my question is why? Why would you want to expose money to a higher risk asset? When I say it like that, it actually sounds crazy. But why would we want to expose ourselves to high risk assets? Any idea there? So Nico suggests liquidity. Okay. Any other answers? Okay. Corbus, high risk, high return. Okay, so when the market uncertainty is deemed as low, or the risk is deemed as low, then one would think, okay, let me allocate cash to a higher risk asset. Because the risk is relatively low, my chance of making good money now is relatively high. I'm willing to take on that risk. Okay, and Lee says higher probability, higher return. So when the market risk then is perceived as high, market participants okay, will start rotating money out of the risky assets, and they'll start popping it, allocating it into the havens. Okay, because the idea of higher uncertainty or a higher risk or higher uncertainty translates into a higher risk. It makes market participants fairly nervous, and they think, well, look, I don't want to take a loss. I'm going to start putting my money into a safer investment. So the idea here is, what is the one main theme? Okay, I guess there's a few, but what is the one main theme that has introduced this element, this variable of uncertainty? What is the one variable? Anybody got okay, so Nico says the economy, Richard says the news. But if I say, what is the one item, Richard, what is the one item in the news that seems to be creating the uncertainty? Boniface says politics. Again, more specific, there is one news item that has been dominant for about 18 months. Nico says, trade. Michael got it. Trade. The trade war has been dominating. It's Richard, the China trade war. Exactly. The idea here is that it has introduced an element of uncertainty. So as soon as that uncertainty uh, uh, escalates, market participants tend to see the market as more risky. More risky translates into possible heavier losses. What happens is there's going to be a rotation of capital into the lower risk assets. Okay, so that's what we're talking about. It's uncertainty, uncertainty. Now, let's be very, very clear, because I've said this is an item that's been dominating for the last 18 months. But the truth is, in the last 18 months, we've also had some good times. Okay, it hasn't been an 18 months of complete uncertainty. So the idea here is, just like time frames in technical analysis, right? The time frames have various trends and cycles. So on the weekly chart, we might see the trend moving up, and on the daily, we might see it coming back down. And there's all types of cycles with regards to risk on versus risk off. So there's no doubt that in terms of macro economic implications, the trade war itself is massive. We've seen manufacturing coming down remarkably. This week we've talked about non-manufacturing PMI. We've talked about low wages. We've talked about low growth. We've talked about missed retail sales. GDP in China's coming down. On the full 18-month, we've certainly seen that it's had mass macroeconomic implications. But within those 18 months, we've also seen periods when it has escalated and de-escalated. And that's where I guess that's where we are. That's what we trade, those swings. So just as we see these peaks and troughs that tend to chart, and we analyze them every day. Those peaks and troughs are market participants' reactions to how they view the uncertainty. Is the uncertainty getting bigger? Well, if the uncertainty is getting bigger, they're probably going to rotate into safer type of assets. If the uncertainty is getting smaller, well, then they're willing to take on a little bit more risk because things are more certain. So that's the way market participants tend to behave. They get uh, chased around by risk rather than doing the chasing. The risk is chasing us as market participants. Okay, and that's how we get the peaks and troughs. Now we've got break this down even further, because we've been talking about moving into risk assets. We've been talking about havens, but we've actually got to start defining exactly what those are. Okay, because that's going to help us in terms of looking for where is the money being allocated. So the next question I pose to you is, of course, let me bring up this next line. Different assets, different financial instruments have different risk profiles. Okay, and that's important for us to know, because money is going to be changed between these assets. Okay, it's going to be rotated around to these various asset classes, very much dependent on market sentiment and related risk tolerance. And to be absolutely clear, with regards to if the uncertainty is growing or if that uncertainty is declining. Okay, so the question is, what do we regard as risk assets? What do we regard as risk assets? Go ahead and type that out. I've got it in the next line, but just go ahead and type those out so we can start building a model to analyze the risk on, risk off modes. Okay, so Lee says emerging markets. Okay. I want to even go more specific than that, Lee, in terms of actual asset classes. I'm talking more about actual assets that you can allocate your money to. Okay, so Francis says gold, silver, Japanese yen. Now, Francis, give me are those risk assets or are those havens? Okay. Exactly. So this is the next line, and Richard says it. Stocks are regarded as riskier than bonds. Okay, so for our purposes, and we can try and keep it as simple as possible, because we're not bond specialists, or some of you may be, and I'm not. I'm not a bond specialist. I'm not a stock market specialist. I'm sort of I tend to follow forex and indices, but generally, stocks are regarded as riskier than bonds. Okay, and that makes perfect sense. Think about if you were running a business and your business was um, had a lot of business to do with China, whatever your business is. Now the trade war starts. There's uncertainty, depending, I guess, on what your business is. There's no doubt about that the uncertainty has become heightened in your business. That's similar for listed shares or listed companies, listed stocks. Okay, when there is heightened uncertainty, shares, stocks, okay, those tend to suffer because they are regarded as risk assets. Now, Richard has written here that the bonds are regarded as the haven. Now, think about it. If you put money into a government bond, one will expect your money to be relatively safe. I mean, we're talking about so as opposed to emerging markets here, Lee, we're talking now sort of the industrial economies. If you had to buy a British gilt, okay, if you had to buy a British gilt, you would expect it to be a solid investment. And after the bond matures, you'll get your capital back, and in between that, you're getting your interest payments. And Michael is right. Michael says depends which governments exactly. So it says here, if you take a look at the slide, and with regards to within bonds, okay, different bonds will have different risk profiles. So Michael suggests that it depends which government, and I would agree. I mean, the idea is you probably would trust a more um, developed economy than a less developed economy, and that should be reflected in the price and the yields that the various bonds um, give, right? And you would expect that the longer term paper would be fairly safe if you if you if you give the U.S. government money, you lend the money for a 20-year bond. You would expect that in 20 years you'll get it back, right? So the idea here is the bonds typically are regarded as havens because um, they are fairly they are insular to downturns, whereas stocks are not. Does that make sense? I want to make sure I haven't confused anyone. Stocks are riskier than bonds. Stocks can come down quite heavily, whereas if you put your money into a bond, you would expect it to um, be a much safer type of allocation of funds. Does that make sense? Let me put it this way: is there anyone that doesn't understand? So Boniface asks, how do we classify gold and oil? Well, out of those two, there's no doubt about it that gold is the classic safe haven. There's no doubt about it. Okay, gold is your classic safe haven. I wouldn't regard oil as a safe haven simply because it's a very volatile area. The Middle East is an exceptionally volatile area, and I would expect also, besides the politics in the area, in that particular area, oil in itself is a very political type of commodity. So, in terms of safe havens, Boniface, I would much prefer personally gold. Much prefer. It's your classic safe haven. The uh, if you have an ounce of gold um, sort of in your pocket, you would be fairly confident that you are walking around with a fairly valuable asset. Okay, so gold is your classic safe haven. Now, if the stock market is appreciating, that is what we call risk on. Okay, so when stocks or shares are appreciating, that is risk on. Okay, so when I or a market commentator suggests, well, we have a risk on day today, that means that we're likely going to see the stock market appreciating. Okay, that is what risk on generally means. Money typically will be flowing out of the havens, going into the stock market, and if the stock market is depreciating, that is risk off. There we'll see money flowing into the havens. What are the havens? We should see money flowing into bonds, and we should see money flowing into gold. So if we get a day where we see the stock market is falling, and we take a look at the gold chart and we see that gold is appreciating, that's almost an equal but opposite type of signal. It's a confirmation, right? And that's what we try and do in our webinars. When we do our DAX webinar in the morning, it's fairly difficult to actually get a reading because it's right near the open, and trends take time. You know, the market participants come in. I think the professionals come in a bit later in the day. But the idea is, if we can see that money is already starting to come out of gold, if it's starting to come out of silver, if it's starting to come out of the Japanese yen, these are all regarded as havens. And at the same time, we've seen the stock markets are starting to move up. Well, those are almost confirmation signals. So we're trying to get this model working for us. Now, just like there are bonds that have different risk profiles, we also got to realize that within the stock market, okay, there are sectors that are regarded safer than others. Believe it or not, there are sectors within the market that are safer than others. Um, let me ask, uh, let me ask you guys this. Let me pose this question: which is a risk on sector in the stock market? Which is a risk on sector in the stock market? Yes, perfect. Richard says technology. Okay, technology is risk on. Okay, when the uncertainty is declining, tech stocks generally would perform very well. The FANG stocks. Yeah, Tin says the FANG stocks. I would agree with that. Let me pose the following question: which are risk off sectors in the stock market? Perfect. Okay, so Richard suggests utilities, and I would 100% agree. Which other ones? There's another two that I'm thinking of. Another two. Some consumers. Perfect. Now, Michael, okay, now you've both said consumers. That is really, really, but which consumers? Okay, which consumers? Sorry, I'm trying to uh, um, really get to the bottom. But not all consumer stocks would be uh, risk off. Some would be risk on. So there is a difference between what we call um, consumer staples. So your supermarkets, fast moving consumer goods, exactly, Unilever. So the consumer staples, the chain stores, the bare necessities to survive, those are your risk off, whereas your risk on consumer stocks would be more kind of your Armani type of your sort of high end um, discretionary type of consumers, which when there's an economic downturn, you would not really go out of your way to spend cash on something that's completely discretionary, but you'd rather allocate it to the staples. So within the consumer sector, you'll see that in the stock market, they generally have what they call consumer staples and consumer discretionary. The discretionary in the US actually called the cyclicals. Okay, so that's another way you can measure risk on versus risk off. And then Lee has suggested the medical or in the healthcare sector. Healthcare is also a very defensive sector. Okay, so what happens is that when there is a risk off, uncertainty starts growing. Market participants are reluctant to allocate cash to sort of your high growth companies like your technology, or to allocate funds to your say your discretionary sort of high-end retailers. Well, you'll see that money will start going into healthcare stocks, because if somebody needs to be treated, they need to be treated. Just can't can't really help this. Um, Notwithstand, you have to go, whether it's a boomer or bust cycle. Same with buying food at a supermarket. You have to do it, whether it's a boomer or bust cycle. Same with utilities, as Richard says. The utilities, people need to be supplied with electricity. They need to be supplied with water. Okay, and utilities, by the way, pay phenomenal dividends. So even within the stock market, you can make the idea. But for our purposes, we'll keep it nice and simple. For our purposes, we're going to be looking generally at uh, the, the S&P 500, and that's what I've used for this particular webinar. But I would suggest
Okay, I would suggest that we also look at the Russell 2000. That's going to be a super, or it is a super index to measure sentiment. And we're also going to be referring to, in terms of bonds, we'll be using the US 10-year. Okay, just so that's the measurements we're going to use. Any questions before I get on to the next slide? Okay. Let's march on. Okay, what have I written here? There's a constant rotation in asset allocation. Okay, fair enough. And havens theoretically offer lower returns, but are less risky. Okay, that is, they provide downside protection. Okay, the havens theoretically provide downside protection. The truth of the matter is that havens can be awesome in terms of capital gains. Okay, the more money that gets allocated to the havens, the faster they're going to appreciate. Likewise, when the money gets moved out of the havens into the risk assets, there's still going to be chance of loss there. So theoretically, sure, it offers lower returns and are less risky. In reality, I would not count on that. Okay. Okay, so Richard suggests, and I would need to do more work on this, but the 30-year bunds are also very risk off, um, but they do have a negative interest payment. Okay. Alrighty, let's take a look at this in terms of our charts. Okay, so I'm looking at the SPX. This is the S&P 500 right here. And we're looking at the just the last two big bear markets. We're looking at the tech wreck, and we're looking at the global financial crisis. And the idea here is, although I haven't got the labels in here, I'll tell you what each of these lines are. And the reason I took the labels out of all of the charts underneath, it just I, I couldn't see the line chart underneath it. Nevertheless, I'll tell you what it is, and in the next chart, I think it does come up. But this is our S&P 500. This is our tech wreck, and you can see the tech wreck's coming down. Now, this is actually the S&P 500, but it's reacting to the tech wreck. So just as the S&P 500 is coming down, because the venture capital market in the US is starting to capitulate. The second chart is gold. Gold is just starting to pick up there. Okay. So this is actually not on a speculative basis. This is more in terms of an asset allocation based on investment patterns. You can see that between 2001 and 2003, as the S&P 500 starts coming down, well, you've got the gold market is starting to show signs of appreciation. Okay, this third chart is actually the US dollar Japanese yen. There is money going into the yen. It does take some time. Okay, there's a little bit of an anomaly here. Okay, and then the fourth chart is the US dollar Swiss franc. Okay, so in other words, as the S&P's 500 is coming down, we're getting gold moving up, we're getting Japanese yen moving up, we're getting Swiss franc moving up, and then the very bottom chart is our 10-year yield. Now the 10-year yield is coming down. Now that's very, very important, because what the yield of a bond is, it's got an inverse relationship to the price of the bond. In other words, if the yield is coming down, it's instantly telling you that the price of the bond is moving up. So my question I'm going to pose now, so I want to make sure we're all on the same page. Okay. Why is the price of the S&P 500 coming down? Why is the price of gold moving up? Why is the price of bonds moving up? Okay, why is there money moving into the Japanese yen, and why is there money moving into the Swiss franc? Okay, and this is around the tech wreck, the capitulation of the tech market. So why do we see price come down on stocks? Why do we see price going up, particularly in gold and in bonds? Richard says fear. Lee says, well, that's the risk-off environment developing. Yeah, Exactly. Both of those are correct. There's fear in the market. And what is that fear of? That fear is of losing money. Okay. And whilst that fear is now starting to take hold amongst the market participants, what's happening is that these market participants are starting to allocate. Okay. So that asset rotation, the allocation of assets that we're talking about, that rotation, that is what we're seeing taking place. We're seeing the money rotating. We're seeing the money rotating out of the stock market, which is our risk on market, and it's been reallocated to our havens. So as money is being taken out of the risk on market, which is our stock market, it means that prices have to come down because money's moving out of it, right? It's being offered. It's not being bid, it's being offered. But while the risk on market is being offered, the havens are being bid, okay? Because now there's a rush to get your money into the havens. So because the stock market's been offered on the market, price has to come down. There is there's a shift out, I guess, in the supply curve. Whereas the havens, there's a shift in of the demand curve, right? And that is effectively what's happening. The market is starting to react to the supply that is now being offered on the risk side, as well as the demand on the haven side. Does everybody understand? You're actually seeing the asset allocation, the rotation in motion by these green arrows. Can everybody see that? Now, let's do the same exercise in the global financial crisis. Okay. Bang. See that? We've got the capitulation in the risk market, which is the stock market. Okay. It's been offered. You can see that offered means that there is a shift out in supply. There's more supply in the market. To absorb that excess supply, prices have to come down. But gold gets bid up. Japanese yen gets bid up. Swiss franc, a little bit of an anomaly here, but gets bid. There is a little bit of an anomaly, I see that. But what I find particularly interesting, okay, this is the global financial crisis. This is the biggest depression since 1929. Okay, what I find particularly impressive on the yield curve, take a look at this little spark down here. See that spark down in the yield just at the end of 2008. It's fascinating. What that spark down is telling me is that there's actually a spike up of prices. In other words, there is total panic at this stage, that people are just piling out of the stock market and piling into the safe haven bond. Does that make sense? Okay. Okay, excellent. So that's the study of the last two bear markets, which of course brings us to where are we right now? Okay, and of course I must reiterate, that this is purely for educational purposes. It's not a buy or a sell. And in fact, if you take a look at the next slide, it's difficult to actually see if it's a buy or a sell. But we're looking at a similar chart here. I've got the names in. You can see the S&P 500. Here's gold. Here's the Japanese yen, here's the Swiss franc, and of course, here is the 10-year yield. And the whole idea is, this is where we are right now. It's much easier to kind of see what happened in hindsight, much harder to see what the market is doing on the right side of the chart. But that's where we operate as traders. So you can see that is total here. Yeah, total picked up the head and shoulders on the DAX this morning. Okay, I think there's a similar pattern here, total, on the S&P. So the idea here is, I don't see it as a head and shoulders, but perhaps as a some sort of congestion area, a symmetrical triangle that is maybe manifesting. I want to see which way that breaks. Now, this is a monthly, I beg your pardon, this is a daily chart. So we're pretty close to action here. But the idea is, imagine we get this symmetrical triangle breaking to the downside. Okay, imagine we get that. Imagine we get at the same time gold punching through its upward, I beg your pardon, punching upwards through its downsloping line. Imagine we get the US dollar Japanese yen breaking through its upsloping line. The US dollar Swiss franc's already broken through its upsloping line. And the US dollar 10-year is also seems to be in some sort of symmetrical pattern. So imagine that there is a downside break out of the US 10-year yield. That would be very, very interesting, because it would be that it would appear that the market relationships are all starting to sync up. They haven't started really syncing up just yet. Out of all of them, perhaps the most concerning would be the US dollar Swiss franc. However, the Swiss franc is perhaps not the best indicator right now, just because of the damage that was done to the market in 2015. I'd like to really see the whole model syncing up as per the tech wreck or as per the global financial crisis. And if it doesn't sync up as that, then I don't think then I think the risk on environment continues. Okay, so we're in this very, very funny stage where we've got a congestion area, but which way this congestion area breaks ultimately determines risk on, risk off on a longer term basis. Any comments around that? Please go ahead and type those through, because this is really where we are at the moment, and we've all got to be sort of looking at this very, very carefully. What we're trying to do here effectively is look at the signals, and then we want to find confirmation signals by looking at, so when the risk asset gives us the risk on asset gives us a signal, we want to see an equal but opposite risk off signal. It builds confidence in which way the market is moving. The fact that we have got some sort of congestion pattern in the S&P 500 and on the US 10-year yield perhaps suggests that there's a battle going on between the bulls and the bears. They still need to sort that out. But as soon as it's sorted out, we'll get an idea of if we are truly in a risk off or a risk on type of environment. Any comments there? Nothing's come through just yet. If there's anything, type those through. So Richard says that the Swiss franc is saying something. Are you saying it's an early warning? Because I was thinking about that. I'm not sure it is. I'm not sure it isn't. What is your take on that, Richard? Yeah, that's you. I'm pretty much. I'm not a big fan of the Swiss franc, so I've got a potential psychological block to it. But there's no doubt that money is moving into the Swiss franc. You see, the problem is, of course, that as money moves out of the US dollar into the Swiss franc, we get the uneasy feeling that the Swiss National Bank might do something nasty there as well. So Lee's wondered why gold has lost value over the 2008 crash. Well, that's a great question. So Lee, I'm going to sort of say we've actually discussed it. You've got the tools to answer that question. Why do you think gold came down after the 2008 crash? Let's go back. That's the 2008 crash over here. You can see it hasn't lost all that much value. It went up to this point, I think it was at 1900, then it's come down. And I think that the best explanation that we have for that, Lee, is of course, money was being rotated out of gold into the riskier part of the market. That would be my explanation. Now, the funny thing about bonds versus gold, historically and traditionally, okay, so think about this. Bonds is a safe haven and gold is a safe haven. Which one would you prefer to hold? Oh, I see. You say there's a sharp decline over here. The sharp decline over here. Okay, I see that. I see that. I'll have to look into that for you, Lee. Just shoot me an email. Um, so Nico says he'll prefer to hold gold. Matei says he'll prefer to hold gold, and Yatin says he'll prefer to hold gold. And my question is why? Because historically and traditionally, you earned an interest by holding onto bonds. So if you're holding on to gold and the havens are basically starting to move up in price, you're actually incurring an opportunity cost by not holding an interest-bearing asset. By holding gold, you're actually incurring an opportunity cost. You're foregoing interest payments. Okay, this is no longer the case. Okay, interest rates are so low these days that perhaps that opportunity cost is evaporating, and I think that's something for us to keep in the back of our minds. Richard writes here, the Swiss pays negative interest, and there's huge bank fees to discourage risk-averse investors parking their money in the Swiss franc. Yeah, yeah, they've actually got the highest negative interest rate as far as I know, subject to correction. I think they're at, last I looked, they were at minus 7.5. But I think traditionally the Swiss franc has been seen as a safe haven. I think the fact that Switzerland is a neutral country is one of the major reasons. And the Swiss franc used to be the only country still backed by gold after the gold standard was um, abolished. The Swiss franc still had a small backing in gold. It's no longer the case, but because I think that stigma has kind of stayed with the Swiss franc. Let's go on to the types of risk. We've got a lot to do, guys. I hope you guys still have time. I knew it was going to be a longer type of um, webinar, but if we run out of time, just type and we can make alternative arrangements. But if you guys are good to go, so am I. So types of risk. Okay, so let's just discuss what risk there is out there. Okay, so we've talked about uncertainty, but I think that we've got to be even more clear than that. The first type of risk I want to suggest is that there's what we call market risk or systematic risk. Okay, I actually have also heard it systemic, but in all my textbooks, it's definitely referred as systematic risk. It's called market risk. Now, market risk is your tech wreck. Market risk is your global financial crisis. It's all encompassing. It's very difficult to escape market risk. Okay, you can diversify as much as you want, but in all likelihood, you're going to be hit by market risk. Okay, it's not easy to diversify. In fact, my next point says it's undiversifiable, although hedging can work. So sometimes the fund managers will take out options as an insurance against any market risk. So that's the first type of risk. It's effectively volatility in the market. Okay, so when we saw the charts of 2002, well, let me say the tech wreck because it was over an extended period. When we see the tech wreck, the volatility in the markets there, the volatility in the global financial crisis, that is market risk. Okay, so that's the first type of risk that we need to recognize. The next type of risk I want to draw your attention to is what we call specific risk. And To a large extent, because we are making an assumption here that you guys aren't big sort of active stockholders, so I apologize, but generally as speculators, we deal much more with specific risk uh, than market risk. In fact, that market risk generally perhaps helps us in our decisions. Nevertheless, specific risk is different to market risk. This is what we call unsystematic risk, and it is specific to a particular instrument. Okay, and the point is that if you do have a diversified portfolio, you are protected to an extent. In other words, if you've got $100,000 and you've got 10 stocks, and each stock's got $10,000 in, and over time your stock shows a stock appreciation. Out of those 10 stocks, there will be some star performers, there'll be some real I guess average performers, and perhaps you're going to have a real laggard. Okay, that's your specific risk. Okay, the laggard most probably has some internal structural problems there. The income statement is showing signs of decline. The balance sheet is showing too much leverage on it. So the idea is that you can mitigate specific risk to a degree. A market risk, you can't. Let's just do, there's another 2 in the slides, and then I'll take some questions. You've got something now called financial risk. And financial risk is a big risk for us. I'll go into this a little bit more detail in the next slide or 2, but financial risk is one of our biggest risks. It's probably not a big risk for your average stock investor. Financial risk is all about trading on margin, okay, leveraging up our positions. Now, leveraging up our positions is beautiful when price goes in our favor, okay? It's awful when price goes against us, okay? So we have to be able to have some sort of risk controlling for financial risk. And of course, then we have something called liquidity risk. Okay, so liquidity risk is almost impossible on the forex market. It's almost impossible. It's much more possible on the stock market. It's almost impossible on the treasury markets. So liquidity risk is can you get into and out of your instrument quick enough? So what happens when you have a mass corporate failure? Okay, a mass corporate failure. One of the biggest reasons that prices capitulate so quickly is because of liquidity risk. Okay, so what you will find is that just before a mass corporate failure, okay, so I guess the best one to use here would be Enron. We have talked about others, but the idea here is when the real bad news comes out, you know, when it's finally finally found out that Enron's been cooking the books and Arthur Andersen's been shredding the papers and the evidence, okay, nobody wants to own that stock. Okay, there's no buyers. Okay, so if there's no buyers, you can't get out. But the sellers are desperate to get out of their positions. So how do you exit your position? The only way you can do it is to offer it at a much lower price to try and entice a buyer in. So there's a big vacuum between where price was and where price is. And that is because of liquidity risk. It's very difficult for that to happen on the financial markets. I beg your pardon, on the forex market. The forex market is a $5.3 trillion market per day. Okay, my taste, exactly like Swiss franc in 2015. Exactly, that's the perfect example. Okay, the idea is that because it's a $5.3 trillion market, there should be enough liquidity. You have these weird black swan events, I guess, like the Swiss franc in January 2015, that sucked out all the liquidity. That caused the damage, right? There's liquidity gets sucked out of the market before high highly anticipated market news. So when a when a central banker is about to deliver a rate cut, but nobody knows what's going to happen with regards to the statement. Okay, there's a vacuum in the market, so you've got to mitigate for that type of risk as well. Market risk is associated with the market as a whole. All instruments will be affected. Okay, all instruments will be affected. So what happens is with a market risk, okay, when the markets move up, okay, a rising tide lifts all boats. It's a Wall Street saying, a rising tide lifts all boat. And there is the cruder saying, okay, don't confuse brains with a bull market. In other words, the market, if it's moving up, is going to take generally most of the stocks up with it. When a market is moving down, when the market risk increases, it's going to take most of the stocks down. Now, the question I pose to you, okay, the question I pose to you is when the market risk is declining, when the market risk is declining, what are the instruments we should be looking at? What are the instruments we should be looking at? Stocks, exactly. So when market risk is declining, you're going to look for your risk on assets. When market risk is rising, you're going to start looking at your havens. Okay. Specific risk is associated with an individual instrument, and a stock may fall by its own misfortunes as opposed to general macroeconomic conditions. So if we've got really good macroeconomic conditions, but a company is showing really bad profits, it's probably going to decline. And diversification is key here to limit specific risk. And for our purposes in particular, okay, we have to always use stop losses and risk management. For us, that's the only way we're going to handle specific risk. Okay, so it's very important to understand that you can't get away from the specific risk as traders. We can take a position, and if the specific risk goes against us, we need to make sure it's not a big loss. I'm going to just pause here. It's 3 minutes past 2. I'm really good to go. We've got a lot still left. I just want to take questions here. Please, if there's any questions, go ahead and type those through. Go ahead, type those through. Let me, there's nothing coming through. So let me make sure everyone's still with me. If anybody is not with me, type N. Lise asked, why is the Japanese yen considered a safe haven? I think that's an excellent question. And in my estimate, I think there are 3 reasons for it, Lee. I think the fact of the matter is that it is a country whose debt is owned by its own citizens. It is the only country, to my knowledge, whose where the majority of its debt is owned by its own citizens. So America's debt is to a massive extent is owned by China or other countries. And most countries' debt would be not held by their own citizens. Japan's is, and the market regards it as safe. So that's the first reason. The second reason is that because the interests are so low, in Japan, there is often what we call carry trading. In other words, mass amounts of Japanese yen leave the shores of Japan searching for yield. What happens is when the risk increases, the investors don't like keeping that money out of Japan. So they repatriate the funds back into Japan as quickly as possible. That causes the Japanese yen to jump. Okay, so that's the second reason. And the third reason is it's self-fulfilling, which I think is also the issue with the US dollar Swiss franc, in that it's just regarded that way in the market. So as soon as the bad news comes out, money instantly goes through to the havens. Does that answer your question? Rob, okay, awesome. Rob, got your comment, excellent. And yes, Francis, of course, there is a recording here. Okay, let's carry on, guys. Toto asks, is the US dollar as a safe haven? And I mean, I have come across that theory, and yes, I guess to a large degree it is. However, I think that the in my mind, Toto, in my mind, okay. And again, if there is any sort of comments around this, please go ahead. In my mind, the real safe haven is the Japanese yen and the Swiss franc, but I don't like the Swiss franc. It's not a currency I like trading. I don't regard the US dollar as a particular safe haven just because the idea is, uh, in my mind, it really depends on the Fed's policy. It really depends on the Fed's policy. The Japanese yen moves up regardless of the weak, loose Bank of Japan monetary policy, regardless. So I prefer to see it in that regard. I also don't regard the US dollar as a safe haven. And I mean, I could come under fire here because gold is the safe haven. And I know that gold generally has an inverse relationship to the dollar. So if money is going to the havens, it makes sense to me that gold will attract the bid. That means US dollar, theoretically, in my mind, should be coming down. Richard writes, the yen is also strong because of its high-tech economy, a lot of high-value exports, historical positive trade balance, and the US nuclear umbrella. Excellent. Thank you very much for that. Okay, so that is very good to know. Nico, I've missed your question. I beg your pardon. Let me just see here. When I send an SMS saying that there's a possible bullish movement expected in the next 11 hours, on what do I base that? I never have ever sent an SMS saying that. I don't think I'm allowed to, according to our company compliance. What I will say, Nico, for me, okay, is that it's very difficult to be 100% certain of what's going to happen in the next 11 hours. We know that there is a very important vote happening tomorrow. So there is a possibility for a very bullish movement because of tomorrow's vote. The truth of the matter is it might be completely bearish, okay, depending which side of the market you're on. Is very difficult. So if you want to email me specific sort of examples, I can look at that. But it's not something that I would condone just based on that. Does that make sense, Nico? No, that's okay. I think it was a great question. No worries. Alrighty, let's carry on here. I'm going to just try to speed it up a little. Financial risk. Okay, so this is very, very important for us. It's associated with borrowing money to invest. That is leveraging up or buying on margin. Okay, if we don't respect this financial risk for us, our playing field, okay, this is going to burn us. And when you get a risk on movement and we've allocated our funds to a risk off asset and we have highly leveraged, that's a disaster that is waiting to happen. So small changes in price will lead to amplified profits, but they could also lead to amplified losses. And the problem with that is that financial risk will destroy traders when the market moves against them. Oh, okay. Okay, so Francis, okay, thank you very much for that. Nico, I beg your pardon. So Francis has written here that you are most likely referring to the text FXCM sends out. I am going to perhaps I need to find out more about those texts. Definitely don't come from me. My communication with you guys is purely at the moment on the webinars and occasionally on email. But besides that, I wouldn't send out a text. Okay. Let's go to the next one, liquidity risk. Okay, it's all about can we enter or exit a position easily. So in the Forex markets, it's the majors versus the exotics. Okay, so the majors, we shouldn't have any problem. The exotics, you shouldn't have any problem. The difference between the majors and the exotics is because the liquidity is so much heavier for the majors, they're much cheaper to trade, which is a big deal for me. Okay. Okay, Rob says, by the way, those texts are auto chart texts, but I'll look into them. I'll just make a note here, auto chart texts. Okay. So for me, I mean, you know, I live sort of in ZA, so I do watch the ZAR, but I don't trade it. I don't think it's worth trading the ZAR for my particular psychological makeup. I'm not saying that it's not tradable. It's a very volatile currency. For my particular, I want to be in profit as soon as possible. So when you've got a very large spread, even though theoretically the swings should make it up fairly quickly, I'm much more comfortable trading the majors. Okay. The liquidity risk is more important in the stock market where there can be illiquid stocks. Okay. And just to give you a little bit of a story around a liquid stock. So this is just a personal story. So my late grandmother owned a gold mine. I think it was called Village Main. Way before I was born, and it was a really an active gold mine. You know, it was a very active gold mine. And my dad inherited the stock, and I'm going back now to 20 years, and I remember this very clearly. I just kind of got involved with the markets, and he said to me, he doesn't know what to do with his Village Main. I think he had the share certificate, and by that stage we had already started going onto sort of electronic platforms. Anyway, we found Village Main on the JSE, and when we sold it, I mean, we sold it at a massive discount because there's just no volume on it. There's no liquidity on it. The mine was completely mined out by that stage. So it's just an idea of how liquidity can affect the price. And then, of course, we've mentioned this, that the Forex market is very liquid, $5.3 trillion per day. We're going on to the last part of the slides. However, there is a fair amount of work to be done here. I just want to give everyone a heads up. Just let me see how many slides are left. It's super important. To me, this is really, if we can get a handle on the next few slides, we're going to be, I think, really well equipped. So where are we here? Okay, we've got about another 11 slides, another 10 or 11 slides, just to give everybody a heads up where we are. Okay, so with everyone's permission, I am going to continue. Okay, this is in my opinion, super important, and I don't think that it is given enough attention. It is based on Dow analysis. Okay, Dow analysis, Dow theory, I think is the better reference. Now, Dow theory, we know, is over 100 years old, and people just don't focus on this phase analysis, but I think it would make such a difference to our risk on, risk off. Now, we have discussed this, and I want to really unpack it in the webinar. And Dow theory postulates that a bull and a bear market unfolds in 3 distinct phases. Okay, and the bull phases are as such. The first phase, as we go into a bull phase, is what we call renewed confidence. Renewed confidence is actually not the right word, because the confidence actually is not renewed at this stage. It's being revived. Okay, so the true way to think about it is reviving confidence. In other words, it's not clear in the market that there is a reviving confidence, or there is an underlying confidence. But that's the first part of the bull phase. That then evolves into the improved earnings phase, and that then morphs into our rampant speculation. And I think when we did our first chart, we looked at the Bitcoin. When I asked that question, when would you be allocating funds? Remember, we're looking at November. It was a weekly chart. We're looking at the last week in November. It really had a mass move in December. And the question was, would you be allocating funds to the Bitcoin at that particular stage? And the phase analysis over here, I think, would have been massively instructive, because according to this, it would have been clear that we were entering the rampant speculative phase. And now, one of the things about rampant speculation, and I'll just say it here because I thought about it and I don't think I've typed it out, is that when we're in the rampant speculation phase, it just seems that it's impossible for the markets to go lower. Everybody will be thinking it's impossible for the markets to go lower. When the Bitcoin was moving up towards its $20,000 price tag, in my mind, or in my heart, let me say, in my heart, I was thinking, well, this is absolutely remarkable. This thing's unstoppable. But because of phase analysis in my mind, I was thinking the last buyer is going to be sucked in, and then there's going to be real trouble. So this is a real useful tool. So let's take a look at the bear phases. Okay, the first part of the bear phase is the abandonment of hope. Now, I will challenge us as the webinar attendees to really assess: is this perhaps not the stage where we are in now? Are we perhaps in the abandonment of hopes? We might not be, okay, but we might be. So just keep that in mind as we progress through this. Through the rest of the slides. The next part is deteriorating earnings, okay? And then, of course, we have the panic selling. And if you remember when we looked at the, if we looked in the, back a few slides, remember I pointed out that little spike in the US 10-year yield. It spiked down. Well, that's your panic selling. That was just money, the last bits of money just shooting out of the market as the they couldn't stand the pain anymore. Let's just take a look at a comment by Richard. So in Richard's opinion, we are in a very high risk environment now because of a very low or negative interest rates, with real inflation running around 2%, quantitative easing, share buybacks, and some major central banks, including the Fed and the Bank of Japan, and government support of risk assets, which has created a bubble which must come down to their true values somewhere down the track. And I would agree with 99% of that. Richard, what I would suggest is that it's perhaps even more dire than that, in that your real inflation is actually close to zero as opposed to 2%. In other words, when you take your interest rates, or perhaps in the US, I've got to think about it in more in Europe, but if you take your interest rates, which are missing their target of 2.5, and you divide price Okay, any price adjustments by your CPI, I'm not sure we're going to get that 2%. I think it's going to be closer to zero. What do you think about that? I'd be very interested to hear. Let's go on to the renewed confidence phase, and let's unpack the. Now these slides, they fairly busy slides, so I apologize for that. But each line item I think is well worth noting. Okay, well worth noting. Now, to get into the idea of the reviving confidence or the renewed confidence phase, I would probably need you to take yourselves back to March 2009, if you can think back that far. Okay, because in March 2009, the market was it had been smashed left, right, and center, absolutely smashed. And I remember going into I went into a brokerage. I went into a brokerage. Speaking to a broker. Now, the tools that you'll see closer, the analysis that I'm going to show you close to the end of these slides, I had looked at that stage, okay, and it looked to me that we were entering this revived confidence. And I said to the broker, I said, I think we've hit a bottom. And the broker said to me, no, there's a lot more pain to come. So this phase analysis, I can't praise it enough in my personal opinion. Okay, so let's take a look. So Richard has just said that in England, the true inflation is 2.4%, yet interest rates are only 0.75. Okay, with max depositors can get a savings of 1.15. And it's just a wholly unsustainable situation. I'd actually be interested on your opinion on how the phase analysis fits in with that. I think this will be a super tool to add to that. Let's discuss the revived confidence. Now, the key idea here is that markets are forward-looking, okay? The reason that the pound has jumped since the 1st of October is not because of any great metric that is telling you that as we stand right now, the pound should be jumping by 800 pips or forward looking. When the deal's done, okay, there's no the UK has a fairly measured way of proceeding. In 9 months time, it's going to be in a way better position than it is now, and that's the adjustment. It's because it's forward looking, okay, and because markets are forward looking, okay, when we go into the revived renewed confidence phase, even when bad news comes out, it's generally ignored, okay. That's because all the bad news is being discounted into the price. The markets are looking 9 months, roughly between 6 and 12 months, right? 9 months, approximately down the timeline, and they see better things there. And that's why there is a underlying confidence. But it's not easy to see. You have to have a trained eye to see that things are possibly bottoming. And whilst everything seems gloomy, okay, the market is looking ahead. And one of the interesting things is that most people have lost interest in the market at this stage. So in March 2009, there's been such a mass sell-off. People have incurred such trauma financially. They want nothing to do with the markets. Similarly, if we had to bring up Bitcoin, okay, if we take a look at Bitcoin, there's a mass movement up here. That's clearly the speculative stage. I remember running a workshop at the end of last year, and I think the Bitcoin was there. And I suggested to the guys, well, perhaps we've seen the worst. And the participants there just didn't believe me. They want nothing to do with it. Okay, so that to me is the perfect suggestion that we are in a renewed confidence stage. And ironically, at this stage, you actually have signs of good value. So you've got really good assets at ludicrously cheap prices, ludicrously cheap prices. Okay. So if the market seems to be ignoring bad news, then it's very likely we're at the renewed confidence stage. And just to make it clear there, if the market is ignoring bad news after a severe sell-off, okay, then we could possibly be in the renewed confidence stage. And that's because the bad news has been discounted into current prices. Just got a few comments here. In 2009, so this is from Corbis, I just started trading penny shares. And one day I heard on the radio that Old Mutual shares were much cheaper than its net asset value. I bought some, and after a year, it was up 250%. Yeah, exactly. Okay, that's good assets at cheap prices. Good assets at ludicrously cheap prices. Richard writes here, as a result, the numbers show growth. However, it's artificially induced growth, and the patient has to recover in producing manufactured goods and a great services at the end of the day. Okay, I'll come back to that. Let's discuss this as we get closer to the top of the cycle. Okay, let's move to markets are leading indicators. Let's move to the second phase. So the first phase is the reviving confidence, the renewed confidence phase. Okay. Incidentally, by the way, who's who's um, who's participating in the renewed confidence stage? Who do you think's taking? Who's the buyers of these cheap assets? Any ideas there? Your money managers. It's your pros, exactly. Professionals, 100%. Guys like Warren Buffett who see that there are super companies at super cheap prices will be snapping it up, and the guys selling them don't want anything to do with it anymore. They've just had too much pain. Um, Improved earnings. Okay, so this is the second part of a bull market. It's where we see general improving economic conditions. At this stage, of course, we have good earning reports. We have good economic and profit forecasts. And of course, there is a general sense of optimism. And the all important metric of unemployment is decreasing. And the improving earnings phase is, of course, our longest of the three phases. Okay. Now, when we go into the improving earnings phase, what we want to be doing is we want to be looking for the dips as buying opportunities. So typically, you can see the reference here to Dow theory because it refers to improving earnings as opposed to improving economics because it was very much focused on the stock market. But we can still use an improving earnings in the stock market to know that, well, it's the risk on assets that are the potential performers as opposed to the havens. As at this stage, okay, so that now we've passed phase one, the reviving confidence is gone. By stage two, okay, by phase two, it's clear that there is some sort of economic improvement going on. So your asset rotation becomes noticeable. Asset rotation becomes noticeable. Okay, so that is the improved earnings. Richard, hold that thought for a moment. I'll refer back to it. Hold that thought for a moment. Okay. Now, let's go through to the next stage, which is our final stage of the bull market, the rampant speculative phase. Risk increases substantially in this phase. Risk increases substantially in this phase. Typically, valuations will be elevated and extreme in some circumstances. Now, I took the liberty of putting out the PE ratio for the last 90 years or so of the S&P, and I've got 3 different levels here. So the green level is the general valued area. Okay, the green area is where the markets have generally seen the PEs topping. Okay, guess where we are now? Okay, we're just starting to dip below it. Then, of course, we've got the orange area. Now, the tech wreck, the PE ratio made it to the orange area in the tech wreck. Okay, well, look at the global financial crisis. Okay, so you can see we may very well be at the top of the market. What we got to do is we've got to go back to that model where we saw the S&P 500 in that symmetrical triangle. We saw the 10-year yield in that symmetrical triangle. Well, if those start suggesting that we are toppy, the PE ratio is supportive of that. Here, what I've done is I've put the PE ratio on top of the last 90 years of the actual S&P 500. It's not a perfect, I haven't lined it up perfectly, but you can see that by and large, when we've reached this 20 level, we're pretty close to market tops. Not always, but a lot of the time. Okay, we're very close to market tops at these extreme levels. That's where we are right now. All right, Pamela, thanks very much. Let's go back to my notes. The problem with the last phase of the market is that everyone is bullish. Remember, I suggested that at this stage, nobody thinks that the markets can decline. Okay, nobody thinks the market can decline. Now, I'm going to come back to Richard's question here, and we can unpack it with this particular slide. So the comment here is markets can no longer act as leading indicators because they are being artificially propped up with buybacks, QE, government and central bank action. I see how the Fed jumps the minute Trump shouts and the markets have a hiccup. Bitcoin unregulated and scams are not good, but the official markets are doing a degree of scamming. Indeed, but I would suggest that perhaps the mere fact that that is what we are suggesting here is probably a symptom that we're at a top. And so you understand that the fact that we are suggesting that there is no longer a business cycle is probably suggestive that we are at a top of a business cycle. In 1929, there was a really well-renowned economist by the name of Fisher. Can't remember his first name. I don't think it was Irving, but it was Fisher. And what Fisher said is we've now reached a stage in the economy, or a plateau in the economy, of permanent economic prosperity. I mean, I've paraphrased and probably completely hashed the quote, but if you Google it, famous quotes before the 1929 crash, okay, this type of thinking is typical of a top. Okay, when we're at the rampant speculation phase, central banks have acted by raising rates to slow the economy from overheating. Okay, Matei says that in Elliott wave, it's suggestive of the wave 5. Okay, which I'm not an Elliott wave technician, but I would probably agree with that, Matthijs. Now, once you have these rates moving up, well, they're going to start impacting on the income statements and definitely start impacting on personal consumption. Okay, and of course, price volatility in asset markets is higher. Speculation by the public is evident. Now that was clear at the in the bubble of Bitcoin. That was clear. Perhaps not so, and it was clear in the tech wreck. Okay, perhaps not so clear now. But I tell you what is clear. I tell you what really is clear. I think Rob, you'll like this one. New risky floats become evident. New risky floats become evidence. Okay. The markets rise on a smaller number of stocks. Okay, that's the breadth. We spoke about it briefly. But if the market is getting supported by just the large caps, and we're seeing the Russell 2000 moving down, well, is there not some sort of disconnect there? Something that we need to pay attention to. Everyone will be talking about the market and is happy to give advice. This is huge. Again, I refer to the tech wreck because it was a standout there. To a degree, the global financial crisis. I'm not sure how many property seminars I went to, but I went to a fair few in my time. Okay, and that's in retrospect, I think was a symptom. But in Bitcoin, everyone was happy to tell me to buy Bitcoin. I mean, when guys, it's probably a generalization, but I have had clients come to my workshops and suggest, Bitcoin is the best thing ever. The best thing ever. Now, I don't know if it is or if it isn't, but I do know that the guy offering me that advice hasn't been in the markets for 20 odd years, and I have. Okay, so it's just something to keep. When a gym instructor is telling you to buy this stock, it's a warning sign. Okay, it's not advice. Don't do it. Stay away from it. Alrighty, so Lee asks, what is a risky float? What is a risky float? So a risky float is when there are highly touted markets that companies that are going to be listed. A float is a listing on the stock market, Lee. So a very speculative new company is going to be offered on the stock market. That's a risky float. Does that help? Okay. Now, you'll hear things. It's different this time. You'll hear that a lot. Okay. It's not. Okay. The more things change, the more they stay the same, right? Now, look at this one. Richard, tell me what you think about this one. The government has, that should be an HAS. Is Francis here? She's going to shout at me. The government has, sorry, Francis, has smoothed out the business cycle. The government, have you guys heard this? The government has smoothed out the business cycle. Okay. The authorities have worked out how to engineer soft landings. Okay. This is not new. Okay. The fact that we're hearing it now in 2019 is not new. Okay. Every time we go into a rampant speculative phase, these type of comments crop up every single time. So the idea is, if this is the kind of stuff that I'm hearing, it's pointing to a rampant speculative phase. Richard says, the famous last words before failure, they are bragging that they are gods and will have a hard fall. Total increasing number of IPOs, which phase could be put? So the genuine bullish phase is the increasing earnings phase. You'll see some really quality IPOs coming to market then. Okay, you'll see really quality companies coming in. But it's towards the end of the business cycle where you've got relatively when you've got really, I guess, personable owners of private companies who are trying to cash in on the markets. Does that sound like any recent float that almost went ahead recently? Okay, no names mentioned. Okay, let's go to the next slide. Abandonment of hope phase. Abandonment of hope phase. Exactly, Yachin. Exactly. 100%. Okay. All right. So abandonment of hope phase. Markets are overvalued. I refer you back to the PE ratio chart from Macro Trends. By the way, the PE is not a great metric. We've discussed that before. It's certainly not good for financial companies. It's certainly not good for miners. Okay. Um, but a metric that is potentially a better metric is the dividend yield. I never really looked for it, but you would see definite speculative phases when the dividend yield starts showing spikes as well. Okay, Richard, again, hold your breath, Richard. You're jumping the gun. You're jumping the gun. Exactly. Okay. Abandonment of hope phase. The markets are overvalued. Okay. Now, interest rates get talked about in the news media. Let me ask you, okay, markets overvalued? I refer you back to macro trends. Interest rates been talked about in the news media? Anybody been tweeting about interest rates lately? Just putting that out there. Okay. Interest rates top out in this phase. Interest rates tend to top out in this phase. Now, let's go back to our trading view. Let's bring up trading view. And we want to go back to the Fed funds. Let's just change this to a line item. And okay, so interest rates topping out happens in the abandonment of hope phase. This looks like pretty toppy to me. Okay, it looks pretty toppy to me. Okay. And the real economy seems strong. Well, the truth of the matter is the real economy in the States has looked exceptionally strong, but is starting to show signs of cracking. Okay. So I wonder if perhaps we're not even moving into the next phase. Now, all the buyers are in. All the buyers that are prepared to go long are now long and are awaiting their returns. Often the bid at the highest price has already been charted. Markets tend to ignore any good news. Okay. Markets tend to ignore any good news. Okay. So, if we had to do a look at the S&P 500, I think that the news was fairly good last week, but we are on a line chart nowhere near the all-time high. Okay. The start of the sell down is viewed as a correction in the bull market. Okay. Now, let me just make it very clear, okay, that I don't know if we're in the abandonment of hopes phase, but it just sounds like a lot of check boxes are being ticked. It really becomes evident, I guess, after the fact. But that's the whole point of phase analysis. We're trying to assess, are we in a risk on, or are we moving into that risk off environment, right? That's what we're trying to assess. Let us, so at the start of the sell down, it's viewed as a correction. Okay. Now, there is often an event or theme that builds and is touted. Anyone heard of the tech wreck? Anyone heard of subprime mortgage? I wonder if QE or negative interest or untested monetary policy becomes a theme that starts building. I wonder. Okay. Let's just take a look. Richard writes here, in the UK, even fiscal discipline has been abandoned in favor of Ponzi economic promises. The wrong people are running the macro economy. They are all politicians wanting to be celebrities, even the central bankers. Well, what I can say is that the US does have a celebrity as a president. Just that thought comes to mind. I just say it tongue in cheek. Now, okay, Richard, the next one you're gonna like. Watch this. High-profile floats list at lower prices than expected. High-profile floats. High-profile floats list at lower prices than expected. Can anybody think of examples here? I can think of two, and I think that Richard has given me a third one. No meat. So WeWork never listed, which is again symptomatic. Anyone keep track of the Uber listing? Anyone keep track of the Lyft IPO? Just putting that out there. Okay, going back to the next one. Other listings are abandoned. Okay, so I'm just suggesting that we've got to be on our guard here. Now, phase analysis takes time to unfold. Okay, it's not a speculative tool, but it's a super tool to have in our arsenal. Let's go on to the next phase. Deteriorating earnings phase. This is the longest of the bear phases. Now, when I wrote that, I was a little nervous to put it. The truth of the matter is that bear markets are much more vicious and much shorter than bull markets. Theoretically, in terms of the textbook, and according to the Dow theory, okay, which is over 100 years old, right, but seems very, really relevant all of a sudden. Yatin says, everything we've said is similar to Bitcoin and altcoin, right, Yatin? Exactly. Rob, one I missed completely, Saudi Aramco IPO, okay? So, I don't know how many times that's been on hold. Supposedly it's on hold now so analysts can redo the metrics, okay? Lee says, bulls climb up the stairs, bears jump out the windows. I like that. So deteriorating earnings. So it's a very trying time for investors. At this stage, valuations will be reverting to their mean. Okay. The truth of the matter is, even at this stage, there will probably be some value in the market, but even these good companies are not really being bid because the expectations is for further weakness ahead. And as more bad news comes out, the markets react negatively, and of course the markets fall further. And a big clue here, of course, is also when good news is largely ignored. It's at this stage when the economic metrics actually start suggesting that we've gone into a recession. So I certainly wouldn't advocate that we are in a deteriorating earnings phase, sort of state-wise. But I am nervous about perhaps the abandonment of hopes. Now, how about this one? The latest Fed asset falls aggressively lower. Okay, Yatin, Bitcoin / altcoin. And the next one is really where a lot of the damage is done. The sucker rallies cause massive harm because investors are trying to pick the bottom, but they just buying into sucker rallies and they get hurt. Eventually, as technicians, we see that a series of lower peaks followed by lower troughs have begun to chart. And it's at this stage when the general public starts losing interest in the financial markets. Okay. I think, Rob, at the stage of the by the second stage, so Rob's asked the question, thinking of valuations returning to the mean, I guess this will lead to more whipsaw action whilst trading, and it gets harder to get a swing to lock in. I'm not sure. I think the whipsaws are particular in the final rampant speculation, moving into abandonment of hopes. I think we get a lot of whipsaws there. But I think once we move into the deteriorating earnings, it's pretty clear that the trajectory is downwards. I think we actually get less whipsaws. And I think what you're actually bringing up is important, because there is a fair amount of whipsawing in the market at this stage, but it's just par for the course, because once those trends lock in, that's really when you uh, uh, make it as a trader. Um, Richard writes, it's about the sustainability of earnings from real selling. Exactly what you're saying there. It has to be based on real economic activity, not cooking the books, right? Let's go to the panic selling phase. Now, the panic selling phase, the market is really starting to come down in a very, very severe and aggravated manner. Well, someone has to be buying at the panic selling phase, and guess who it is? Okay, it's the professionals. They're starting to look for bargains. They understand that the valuations have returned to the mean and possibly even overshot to the downside. So they're really starting to pick up the bargains here. Okay, and they're buying as cheaply as they're buying cheaply, because the novices, geez, they at this stage they want nothing to do with the market. They're cashing out with whatever they've got left, and they don't want to come back to the market. They're so disgusted with the market, and it's been an absolutely painful experience. Well, they have to be selling to somebody, and who are they selling to? Well, they're selling to the pros, because the pros are understanding that what these disillusioned novices are actually offloading are quality companies at really, really low prices. Okay, the market at this stage is undervalued. The fact that the professionals are buying at this stage, there's still no bid, okay, because the offers are coming fairly at a fairly fast pace. So the pros are just absorbing the excess. They're happy just to start building up their portfolios again. Um, Basically, at this stage, there's a general sense that price will never recover, okay, and the majority are exiting while they still have something left, okay. Now, what else could be driving the selling here? The truth is, the metric of unemployment can start becoming really a devastating metric. More and people getting laid off, that they're actually forced to sell financial assets just to stay afloat, okay. There's just a broad sense of financial stress. And let's just bring up this one. Corporate failure is a reality, and there may be some sensational media stories around some large companies that have capitulated. At this stage, the market seems to have discounted the bad news and is not overly reacting to it. And I think the very last point I have here is brokerages shut shop or scale down. Now, these signs should be really, really obvious. Okay, the panic selling phase and the rampant speculator phase are actually, out of all of the phases, they're the most obvious. Okay, those are the most obvious. It's hard. The turning points are the difficult points to pick up. So how do we pick that up? So I'm going to suggest, first of all, this is something that I have shown you before. Where is my, okay, is of course my the phase analysis, but on the monthly chart. So if we go back through to our tech rec and our global financial crisis, okay, the idea is when we start moving from the zone 3 into zone 2 on a monthly scale, and if we can try and line that up with some sort of phase analysis, I think we've got a tremendous toolbox here to really try and get in at the value stage. So this is, there's typically a debate that goes on in the market. Which is the better methodology? Is value a better methodology, or is growth a methodology? And I don't think that debate's ever going to be solved. Okay, you've got advocates for both sides. My point of view is that each has their moments. Okay, the value investors are going to do superbly well when they're picking up right at the end of the panic sell-off, and the growth guys are going to do once we start going into phase 2. Okay, so phase 2 of the bull market. So I think the movement from zone 3 into zone 2 with a panic selling phase, perhaps a renewed confidence stage, that is super useful to know. If we go through to where we are right now, we're in zone 3. Now, if we get zone 3 moving into zone 2, with the idea that the panic selling phase is checking a few boxes, well, I think that we've got to take note of that. But we always want to get led by the phase analysis here. Okay, so the phase analysis we'll keep an eye on. I mentioned that story earlier with regards to when I went into the brokerage, and I suggested that perhaps we've seen the bottom of the market. The reason I was suggesting that is because there were signs of the panic selling phase had now moved into the renewed confidence stage. But on a monthly basis, now at that stage I wasn't using zone analysis, but what I was using was a monthly MACD. Okay, I was looking at a monthly MACD, and the monthly MACD had ticked up. Okay, now I'm not a big user of the MACD, but I think when it's below zero or close to zero after a mass sell-off and it starts ticking up, and again, not to be used in isolation, we use that with the phase analysis, it just helps. It just helps. And it gave really good signals as to the end of the tech wreck, and it gave really good signals as to the end of the global financial crisis. And one would have been well within their rights just to have been sitting out of the markets until the MACD ticked up. Now, I'm going to just throw the next chart out. Please, please, please don't take this as anything but education. Okay, I just was thinking where we can potentially take a look at the monthly MACD. Okay, so take a look at this, guys. The euro US dollar. Okay, now the euro US dollar, there's been nothing but bad news coming out of the euro area. I haven't really sat down and thought about, are we moving into the reviving confidence stage? Have we seen the panic selling stage? I would probably suggest that we haven't. But just take a look at this. Okay, so back over just before 2013, the monthly MACD turned up from below zero, and there was a fair amount of monthly activity up. Okay, after 2017, similar story. I do concede there was a whipsaw signal at 2016. Okay, and now I say, where are we now? The MACD is flat. It hasn't turned up, but it is flat. And it is with this slide that I will, of course, conclude. Any questions? Please go ahead and type those through. Candles are smaller, showing loss of momentum when not in a stage, from Yatin. I'll just read that again. Candles are smaller, showing loss of momentum when not in a bull stage. Okay. Any other comments, questions? Please type those through. I hope this helped, guys. We've gone 2 hours, so I appreciate the fact that you guys have stuck with it all the way through. Absolutely amazing. I hope you found it helpful. I hope you enjoyed it. It's 3 o'clock. We do have the US Open at 3:30. We will do it, but I'm going to make it really short. Okay, so the US Open on in the next half hour, but we'll just do a few charts, talk about the Brexit vote tomorrow, and we'll see exactly. I think we'll keep it at that. And I'll discuss the DAX. I did put on a small position on the DAX. I'm not sure what it's doing. Okay, I'm looking at all the comments. I really appreciated it. I think by and large, it seems that it is very. I think you guys have enjoyed it, which Okay, and I was really nervous before presenting. Thank you very much, guys. I think let us conclude at this stage. I think we all need a coffee, and then I will speak to some of you, if not all of you, in the next half hour. Thank you very much for your time. I really do appreciate it, of course.